Hello, everyone, and welcome to this weekly market recap for the week ending December 13th, 2024. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host here for the next 30 minutes or so. Just wanted to give you my take on what I saw for this week. It's always a pleasure to be with you all and to go over this information. We did have a couple of big inflation reports out during the week. We saw the CPI report out midweek, followed the next day by the PPI report, both of those for the month of November. CPI report came in as expected, matching expectations. The headline number on the PPI was a little bit hotter than expected. It came in at 0.4% rise, and the market was looking for a 0.3% rise. But again, most of what the Fed's looking at is going to be at the consumer level, and certainly the core inflation data is going to be more important than the more volatile headline number that includes energy and food prices. So all in all, I mean, I didn't think it was that big a deal in terms of inflation and the numbers that came in. However, we did see a big spike this week in the 10-year Treasury yield. So we had closed last week, I believe, around 4.15%. Today we closed at 4.40%. So 25 basis points higher in the 10-year Treasury yield. Meanwhile, we've got a Fed meeting coming up this week, and I fully expect that we're going to see another 25 basis point reduction, despite the PPI number that came out a little bit hotter than expected. I still see an economy that is okay, but not vibrant by any means. And so I think the Fed is going to continue the mandate that they started a few months ago, where they said that they were switching policy. And instead of being hawkish, battling inflation, they felt like inflation was going to continue moving toward their target rate of 2%, even though it had slowed, the pace coming down had slowed. They still believe that they were on target and that the inflation rate was heading toward their target level. So all of that, to me, suggests that we're probably going to see another 25 basis point cut on Wednesday of next week. This past week, I'm going to show you a chart and show you some numbers, but this past week really was not a good week historically. I talked about this with our members going into this week, that really expectations should be lowered. Stay away from leveraged ETFs that track the major indices. I didn't think it was worth the risk, given the historical patterns that we're accustomed to. And sure enough, market struggled, especially small caps and mid caps. Small caps were down the most. But let's go ahead and take a look at these numbers and work through some of the charts that I have for you today. So here was this is the 1 week return of the 6 major indices that I like to follow. And you can see the NASDAQ leading. A lot of the Mag 7 stocks, I'll show you all their charts later in the show, but a lot of those Mag 7 stocks really performed well this past week. Several of them breaking out to all-time highs, new all-time highs. So that was good. S&P 500 also benefiting from those Mag 7 stocks, was in that second spot. Transportation stocks down 1%, which isn't as bad as it's been, but still not a great week there. And then, as you can see, mid caps, then the Dow Jones, then the Russell 2000. Russell 2000 really leading the pack to the downside, down to almost 2.5% for the week. Now, if we look at, I'm going to go out 1 month just to show you how bad transportation's been in the last month. So we had a really big breakout there. And if you recall, we had the Dow Jones going up and moving above 45,000 for the first time. So we had the Dow Industrials setting new highs, and we also had the Dow Transportation Average moving up as well. So if you follow the Dow theory, that's a pretty good bullish sign for the economy and for the market. But yet you can see over the last month, we've actually had an about face in transportation stocks. So if there's one thing that maybe bothers me a little bit, it's seeing the transportation stocks underperform by as much as they have over the last month. And again, when you look at the last month, you can see the NASDAQ 100 and S&P 500 leading the way. Mid caps also green, but mostly flat. Dow and Russell down, but down less than 1%. So not really that big of a deal. But we are still, you can see over the last month, seeing leadership from the NASDAQ, which kind of goes against what I expect and what I'm going to expect in 2025, which I believe we'll see some outperformance by small caps. But I'll be talking about that more in an event tomorrow, and then again at the beginning of 2025 when we host our Market Vision 2025 event. But more on that later. Let's move on to the sectors. Again, going back 1 week. This last week, two of the aggressive groups were up: consumer discretionary, communication services. That's really what helped lead the NASDAQ 100 to some outsized gains. Consumer discretionary, led by two of its biggest components, Amazon and Tesla. Both of those set new all-time highs this past week. And Tesla finished on its all-time high on Friday at the close. So a lot of strength from those two stocks, which make up more than 40% of the consumer discretionary ETF, the XLY. Communication services getting a big lift from a lot of internet stocks. Google moved to an all-time high, just absolutely exploded this week. We've seen Meta printing new all-time highs. Netflix pulled back later in the week, but Netflix has been very strong over the course of really 2023, but last several months in particular. And then you go to the bottom of the list and you can see a lot of more value-oriented stocks. So you can see real estate, industrials, healthcare, utilities, materials. So these are more dividend payers, defensive, more defensive oriented. They didn't keep up with the market. So normally when you see a down week, and we were down in most areas, normally when you see a down week, you see the opposite. You see the aggressive groups down the bottom, and you see the more defensive areas at the top, because usually you have more gains to give back in those more aggressive areas, but that was not the case last week, and worth noting. S&P 500. So I wanted to point out a couple things. You can see we're just kind of, moving back a little bit, consolidating the gains that we saw that led to our first close, our first movement up above that 6,100 level, which was just a little over a week ago. But I want you to focus on the left-hand side of this chart, because I've actually pulled up some information on historical December performance, and this might shed some light on the weakness that we've seen this past week. But the first thing I wanted to point out, this is the S&P 500. These are annualized returns that go back to 1950. So from December 1st to the 15th, we have an annualized return on the S&P 500 of 11.22%. The 16th to the 31st, it jumps to 34.68%. So no doubt in my mind that historically the stock market likes the second half of December more than the first half. Now the first half is held back. Look at this December 9th to 15th period, where we have an annualized return of minus 16.92. So the first half of December gets off to a good start from the 1st to the 8th, but then the 9th to the 15th really brings it back down to earth. And then finally, I wanted to mention the strongest part of December, which is the 21st to the 31st. Those are the dates that I refer to as the Santa Claus rally. You might hear others talking about the week between Christmas and New Year's. I believe, based on all my data and research, that it really begins at the close on December 20th. So the 21st through the 31st, yielding or gaining on an annualized basis 40.5%. Pretty strong. Now I'm going to go and show you the same information on the NASDAQ and the Russell 2000. So first on the NASDAQ, pull up these numbers again. 1st to the 15th, minus 6.21. And if you jump down here to the 9th to the 15th, minus 45.97%. That's historical performance on the NASDAQ 100. Now remember, this week we actually did pretty well because of those Mag 7 stocks, but that is not normally the case. Then we go to the 16th to the 31st, and that jumps up to 44.49%. And if you look at the S&P for the second half of the month, it's 34.68%. So another 10 percentage points higher. I will mention, though, that the NASDAQ, these annualized returns go back to 1971. So not all the way back to 1950. The NASDAQ index began in 1971. December 21st to 31st, though, look at that strength that we normally see on the NASDAQ 100 or on the NASDAQ, on the NASDAQ 100 of 61.8%. That's the annualized return. Now I'm going to show you the IWM small caps. 1st to the 15th is basically flat. This goes back to 1988. The 16th to the 31st, up 62.74%. Small caps, which had a really rough week last week. But again, if you look at the 9th to the 15th, that was typical. What we saw here all week long selling, that's typical with what we normally see with small caps from the 9th to the 15th. Check out the 21st to the 31st, though. 64.57%, which is just about on par with the entire second half of the month, 62.74%. But these numbers are greater than even the NASDAQ and the S&P 500. So very, very strong time period coming up for small caps that I wanted to make sure I pointed out. But look at those returns. I mean, normally, the average annual return on the S&P 500 is about 9%. And so when we start looking at these numbers, like the Russell 2000 for the second half of December, we're talking about almost 7 times what we normally would expect on the S&P 500. That's a lot of outperformance. Now, again, this is historical. Doesn't mean it's going to happen this week or the rest of this month. Just like I said, this past week, the NASDAQ was strong, even though historically that's down. So it's not a guarantee. I just like to use this information as another potential signal, something else to be aware of as we move into the second half of December, which historically has been much more bullish. Transports. So here's the big decline that we've seen really since about the 25th of November at the close. We were at 17,750 and now we're just below 16,750. We've given back 1,000 points, which was essentially the entire move on the breakout. So this is not a good look for transports. We did come down to the 50-day. We are in gap support area. So I'm not saying that we're not going to bounce back. I'm not saying that the rally's over in transports. I actually think transports will do very well. But what I do want to point out is look at the higher high here on the transports. Look at the lower PPO reading. So we had higher prices, but lower PPO. That's a negative divergence. What I always talk about when I see a negative divergence is there's usually when the PPO is going up with price action, there's no negative divergence. I look for that 20-day to hold as support, and then we bounce. That was beautiful here. We moved up in price. You can see the PPO was moving up. So when we moved back, we held that 20-day moving average, and then we took off back to the upside. But on this breakout, we reversed back down, failed to hold the breakout level, and did so with a much lower PPO. And that tells me that the 50-day SMA or 50-period SMA, in this case 50-day because it's a daily chart, could come into play along with a PPO centerline test. That's exactly what we've gotten. So we could be poised here for a big reversal back to the upside at this point, because as far as I'm concerned, the negative divergence has played out. At this point, with a 50-day test and the PPO at the centerline, there's no momentum. By default, the PPO is calculated using the 12-period EMA and the 26-period EMA. Well, this is a daily chart, so the 12-day EMA and the 26-day EMA. Well, they're exactly the same. When you get a 0 test on the PPO, that means both moving averages are exactly the same. So anyway, I find that to be really interesting. I could see this reversing back to the upside. It could continue moving lower, but that's not what history tells us. And that's honestly not what I'm seeing in my other signals. I don't believe this market has topped, not from a long-term perspective. So I believe we're going to go back up and set some new highs, possibly in December, but more likely, or depends on which areas we're looking at. So like transports have 1,000 points to make up. I don't know if that's going to happen in December, but I would suspect it's going to happen early in 2025, if not December. All right, I wanted to show you, I've been watching growth stocks versus value. And so what I've done here on this chart is I've This is a weekly RRG chart, and I've used the benchmark as the S&P 500. So anything that you use to compare and to watch the rotation is going up against the S&P 500. So when it's strong, it's going to be over here on the leading side of the chart. When it's weak, it's going to be down here in the lagging. Well, this is the large cap growth index. This is the large cap value index. And look at where they are. I mean, we could extend this tail length and we can kind of see where they've been traveling. But you can see on this chart, value has been over on the left side of the chart. Growth has been over on the right side of the chart. And I think if we pull up a daily, use these same thing. Look at the large cap growth. It's absolutely exploding up and toward that upper right-hand corner. That's very bullish. That means that both momentum and relative strength are accelerating in growth. And look at the other side, value coming back down. So I know, you look at the 10-year treasury yield going up this week, and some are pointing to the possibility of, resurge or resurgence in inflation. I just don't see it, because if you're going to have an inflation problem, the last thing you would be buying is growth stocks. Growth stocks get hammered during inflationary periods. Just go back to 2022. That's when inflation was taking off, and growth stocks were absolutely crushed. Does this look like that Wall Street is setting up for a big inflation problem? I don't think so. So anyway, let's go back to that weekly. I'm going to bring up a couple of other. So I'm going to bring up the mid cap index as the benchmark, and I'm going to show the DJUS growth mid cap, and then also the DJUS value mid cap. And so let's take a look at the mid cap level. We just looked at growth or large cap. Now let's look at mid cap growth versus value. So we'll save these changes and look at what's going on here. Look at mid cap growth here on this weekly chart exploding, and look at value going in the opposite direction. So we're seeing the same thing at the mid cap level. And if I change this one more time, let's pull up the small cap and we'll get rid of these two. And let's pull up the Dow Jones US growth, small cap growth, and Dow Jones US small cap value. And let's look at these. Once again, they were both kind of going up into the leading quadrant for a while. Now growth, small cap growth is continuing while small cap value is rolling back down. So again, we've got growth stocks at every level, large cap, mid cap, and small cap, outperforming value stocks. That doesn't happen in a, possible, explosion higher in inflation. So I'm not buying into it. I think the move in the bond market was simply technical based. We were down the 50-day moving average in the yield, which means that the 10-year or the TLT had been coming up and testing resistance from underneath. So it fell back, and as that went down, treasury prices go down, the yield comes back up. So I think it's more of a technical play than it is an inflation play. And therefore, I don't think it's going to stick, but we'll see. Anyhow, the reason I wanted to bring up this RRG chart, because tomorrow morning we have, I'm going to be joined by my good friend, Julius de Kempenaar. He is a senior technical analyst at Stock Charts. He's the creator and the founder of the RRG charts, and that stands for relative rotation graphs. So the RRG charts, there's nobody that knows them better. Julius is going to join me tomorrow for a free public event. It's going to begin on Saturday morning at 10 a.m. If you come to our website, earningsbeats.com, both plural, earningsbeats.com, you'll see this key rotation into 2025. You can register for the event. I would highly recommend and encourage you to sign up. Even if you can't make the event, I know it's a Saturday morning, not everybody has time to come in to check out a live presentation on the weekend. But if you register, we'll send you a copy of the recording, so you don't have to be present. It's going to be an eye-opener. We're going to be talking a lot about rotation and what that could mean for the rest of December and into 2025. And like I said, there's no one on this planet that knows the RRG better than Julius, who created it. So if you click on that, it'll bring you over to a landing page where you can just register with your name and email. No credit card required. You don't have to worry about, any kind of charges or anything. We're doing this completely for free, giving back to our community. We'd love for you to be a part of the session. It is filling up very fast, though, so I do encourage you to do this as quickly as possible. Make sure we have a seat for you, but just name and email address and hit that register now. Now, if you're on your mobile device, we're going to provide you a slide with a QR code. So if you scan that QR code with your phone, you can go to the landing page and you can register via your mobile device. So anyway, want to make it as easy as possible for everyone. All right, moving on. I want to talk a little bit here about the Mag 7. So let's just go through these charts pretty quickly. Apple, you can see there was the double top. We've broken out. December has been a great month so far for Apple. It's trillions of dollars of market cap just keep growing. It's a great company, and obviously, Wall Street can't get enough of it. Microsoft. Now, Microsoft has come to life, although I don't like the candlestick that we see from Thursday. That's a shooting star candle off an uptrend, so I'm not surprised that we did pull back a little bit here. Also, keep in mind this upcoming week is options expiration week. And the stocks that I'm going over, the Mag 7 stocks, are heavily traded in the options world. So there's a lot, a ton of in-the-money call premium that could get wiped out, or some of it could get wiped out if we see a reversal in these stocks. But if money comes out of these stocks, where do you think that money might go? Could be going right back into the small caps, which had been leading up until the month of December. Anyway, keep that in mind. But Microsoft, not able to get to an all-time high yet, but it was pretty impressive here in December until the candle that we saw on Thursday, that shooting star candle. NVIDIA. NVIDIA is the other one that's been struggling. All the way back in June, I talked about these semiconductors that I thought they had topped, and we had to really watch closely until we got a breakout on the Dow Jones US Semiconductor Index, which had printed a high at 21,000. So just to give you an idea of what that looks like right now, you can see we're at 20,000. Here was the high in June. Here's 21,000. We almost got to 21,000 in July, and then we went right up to 21,000 the beginning of November and backed off again. This is a nice uptrend. We're sideways consolidating, which is great, but we haven't broken out yet. So I think you got to be a little careful with the semiconductors. They're not making those moves in that group. There are some stocks that are making moves. Marvell's done well. Broadcom had a big pop on Friday after their earnings report came out after the bell on Thursday. So there are some that are doing well, but for the most part, we've got many of these stocks that are underperforming, like NVIDIA. It's still a leader in the semi space, but it is definitely lagging some of the other Mag 7 stocks. So there again is the NVIDIA chart, trying to hold on to support just above 130. We'll see if that holds next week. Amazon, big breakout. So here we broke out above 200, went back down just below 200, stayed above the 50-day moving average, and then soaring right back up to new highs here in December. So Amazon looking good. Then we've got Google. So Google making this big breakout above its July high, pulling back Thursday and Friday, which makes a little sense off of this big move to the upside. But clearly, Google has changed the look of its chart with that breakout this past week. Meta, also look at the move in December, breaking out above that double top from back in October. Meta looks good, showing a little bit of weakness here and again with options expiring next week. I'm not going to be surprised if we see a pullback in these names that have had such a big run, these Mag 7. And then finally, I saved the best for last. Tesla is flying. 240 at the beginning of November, and now it's at almost 440 in a month, a little over a month. That's just a massive move to the upside in Tesla. And if we pull up a long-term monthly chart on Tesla, this move has now gone back and taken out that late 2021 high. So that is the all-time high now that we're seeing on Tesla. So, and these are all high octane growth stocks. I mean, mega in terms of market cap. Most of these I just talked about are in the trillions in terms of market cap now. So, as I look at this, I think that we're in a position going into 2025 where we'll see a lot of upside or potential upside. But I do believe that there's going to be leadership in key areas that are going to significantly outperform other areas of the market. So again, we'll start to talk a little bit about this rotation and what impact it could have. Julius and I think it's going to be a really lively educational event on Saturday morning. So I hope you can attend. If you're watching this video after the event, still go in and register because we'll send you a copy of the recording. So you can still go in and register. Showed you the ways earlier how you can get to the landing page to register. Also, in the description for this video, there will be a link as well taking you into the landing page so you can get signed up. But anyway, I really appreciate you all checking in. That's all I've got for this week as we go into the second half of December, which historically is much more bullish. If you don't mind, one thing you can do to help us at Earnings Beats, hit that like button. Also subscribe to our channel so you don't miss any of our upcoming shows. But that'll really help us in terms of building our YouTube presence and community. So anyway, all of you have a great weekend. Let's see what next week holds. But, I think probably sooner than later, we're going to start to see some of the other areas catch up to those Mag 7, especially with the second half of the month, the more bullish half of the month upcoming. Anyway, have a great weekend, everybody. Happy trading.